There's a number that sits between you and financial stability. It's not $1 million. It's not even six figures. It's $10,000. And if you don't have it yet, every dollar you save probably feels like throwing pennies into an ocean. You're not imagining it. There's a mathematical reason why saving feels pointless until you cross that threshold. And it has nothing to do with discipline or willpower. It has everything to do with how money actually behaves at different scales. Let me show you what I mean. Imagine you save $500. You're proud of it. You should be. $500 is real money. But then your car breaks down, or your laptop dies, or you get hit with a medical bill. And just like that, the $500 is gone. You're back to zero. This happens again and again. You save, something breaks, you spend. The cycle repeats so many times that eventually your brain starts treating saving like a game you can't win. Why bother putting money aside if it's just going to evaporate the moment life happens? Here's what's actually going on. Below $10,000, you're not saving. You're plugging holes. Your money isn't growing or compounding or building anything. It's sitting there waiting to be destroyed by the next emergency. And emergencies are not rare. They're the baseline. The average American faces an unexpected expense of at least $400 multiple times per year. If your savings account has $800 in it, you're not prepared for 2 emergencies. You're 1.5 emergencies away from zero. This is the trap. Small savings don't protect you. They barely cushion you. And because they don't protect you, they don't give you the psychological reward that makes saving feel worth it. You never get to experience what money is actually supposed to do, which is create options. Instead, you experience what it's like to watch your effort disappear every few months. Now, let's talk about what happens when you do have $10,000. $10,000 changes the physics. It's not about the number itself. It's about what that amount of money allows you to stop doing. With $10,000 in the bank, you stop making expensive decisions out of desperation. You stop paying overdraft fees. You stop putting emergencies on credit cards at 20% interest. You stop taking payday loans. You stop choosing the cheapest option that breaks in 6 months instead of the durable one that lasts 5 years. All of those things cost you more money over time. They're poverty taxes. They drain wealth, but you can't avoid them without a cushion. $10,000 is roughly 6 months of bare minimum expenses for someone living lean. It's not luxury. It's not vacation money. It's the amount that keeps you from falling into a debt spiral when something goes wrong. And here's the part that makes it so brutal. Getting to $10,000 is hardest for the people who need it most. If you're making $30,000 a year, saving $10,000 means living on $20,000 for a year. That's not a budget. That's austerity. If you're making $50,000, it's still a fifth of your income. And that assumes you have no debt, no dependents, no medical costs, no rent increases. Most people don't have that runway. They're starting from behind, which means the people who most need the protection of $10,000 are the least able to build it. And while they're stuck in that zone, their money is doing nothing. Let's be specific about this. If you have $1,000 in a savings account earning 4% interest, you make $40 in a year. $40 before taxes. That's $3 a month. Inflation is eating 3% of your balance annually, so your real return is 1%. $10. You saved $1,000 and it grew by $10. A single trip to the grocery store. This is why it feels useless, because functionally it is. But let's say you have $10,000. Same 4% rate. That's $400 a year. $33 a month. Still not life-changing. But now you're covering a utility bill. You're buying groceries. The money is starting to do something. And more importantly, you're now in the zone where you can take small risks. You can invest some of it. You can put $5,000 into an index fund and let it grow at 7 or 8% while keeping $5 in cash for emergencies. Now that $5,000 makes $350 to $400 a year. Compounding starts to mean something. This is the difference. Below $10,000, your money is defensive. Above it, it can start playing offense. But there's a darker layer to this. The financial system is designed around the assumption that you already have money. Credit scores reward people who don't need credit. Interest rates on loans punish people who can't afford to pay cash. Investment minimums lock out people with small balances. Even savings accounts pay higher interest rates to people with bigger deposits. The system is structured to accelerate wealth for people who already have it, and to slow it down for everyone else. It's not a bug, it's the model. And 10,000 is the minimum buy-in to stop being punished. Here's where it gets absurd. Americans are told to save 6 months of expenses for an emergency fund. That's the standard advice. 6 months. But the median household income in the United States is around $70,000. 6 months of expenses, depending on where you live, is somewhere between $15,000 and $25,000. Most financial advisors will tell you this is non-negotiable. You need this before you invest, before you pay off low-interest debt, before you do anything else. But 70% of Americans have less than $1,000 in savings. 70%. They're not even close to the starting line. And the advice doesn't adjust. It just repeats. Save 6 months. As if the gap between 0 and 20,000 isn't a chasm that takes years to cross. Meanwhile, the same economy that demands you save 20,000 is actively making it harder to do. Rent is up. Food is up. Insurance is up. Wages are not keeping pace. The savings rate in the US has been falling for decades. People aren't failing to save because they're reckless. They're failing to save because the math doesn't close. Income minus expenses equals nothing, or less than nothing. You can't save what doesn't exist. So what actually happens to people stuck below 10,000? They develop a different relationship with money. It stops being something you build with. It becomes something you manage day to day. You think in terms of paychecks, not months. You make decisions based on what you can afford right now, not what will cost less over time. You avoid the doctor because the copay is $50. You don't fix the small problem with your car because you can't afford it, and then it becomes a big problem that costs 5 times more. You live in a constant state of low-level financial emergency, where every decision is a trade-off, and every trade-off has a hidden cost. This is expensive. Being poor is expensive. Not having $10,000 costs you more than having it. But you can't save your way out of expensive if you don't have the margin to start. And this is the psychological break. Saving requires belief that the future will be better than the present. It requires trust that the money you set aside today will still be there tomorrow, and that it will actually help you. But if you've saved before and watched it disappear, that trust erodes. Your brain starts to treat saving like a losing bet. Why delay gratification if there's no reward? Why not spend it now on something that makes today slightly less miserable? This isn't irrational. It's adaptive. Your brain is correctly identifying that small amounts of savings don't change your situation. They just delay the inevitable. So it stops trying. But here's the trap within the trap. The moment you stop trying, you guarantee that you'll never reach 10,000. And without 10,000, you stay in the cycle. The only way out is to keep saving even when it feels useless. Even when the math says it barely matters. Because the alternative is staying at 0 forever. This is the thing nobody tells you. Getting to 10,000 requires you to act against what your experience is teaching you. It requires you to keep putting money aside, even after it's been wiped out 3 times. It requires you to believe in a threshold you haven't reached yet and can't fully imagine. It's not about discipline. It's about enduring a long period where the results don't match the effort. And most people can't do it. Not because they're weak, because the system is built to make it almost impossible. Let's zoom out for a second. This isn't just a personal finance problem. It's a structural one. An economy where 70% of people can't cover a $1,000 emergency is an economy that's brittle. It's vulnerable. When people have no buffer, they can't absorb shocks. A recession hits harder. A medical crisis becomes a financial catastrophe. Job loss turns into homelessness. The lack of savings doesn't just hurt individuals. It destabilizes everything. And yet, the policy response is almost always to tell people to save more, as if the problem is willpower and not wages, as if the issue is spending habits and not the cost of living. The advice stays the same even as the conditions that made it possible evaporate. So where does that leave you? If you're below 10,000, you're in the hardest part. The part where nothing feels like it's working. The part where every dollar saved feels like a dollar wasted, because it's going to get spent anyway. And I can't tell you that it's going to feel good or rewarding or even rational to keep going. It's not. It's going to feel like you're filling a bucket with a hole in it. But the bucket does eventually fill. Not because the hole closes. It doesn't. But because at a certain point, you're pouring faster than it's leaking. And that point is somewhere around 10,000. Maybe a little less. Maybe a little more. But it's real. The shift happens. Money starts to feel different. It stops being something that disappears and starts being something that accumulates. The question is whether you can survive long enough to get there, and whether the system will let you. Because here's the uncomfortable truth. Most people won't make it, not because they don't try, but because the distance is too far and the obstacles are too many. And the ones who do make it will often do so because of luck as much as effort. A tax refund, an inheritance, a period of time where nothing broke. The gap between 0 and 10,000 isn't just about saving. It's about not getting unlucky, and that's the part we don't talk about. How much of financial stability is just the absence of catastrophe? So if you're sitting at 2,000 or 5,000 or 8,000, and it feels like it's taking forever and nothing's changing, you're right. It is taking forever. It's supposed to. This is the grind. The part where the math doesn't reward you yet. The part where you have to keep going on faith. And if you don't make it, it's not because you failed. It's because you were playing a game with rules designed to keep you from winning. But if you do make it, everything changes. Not all at once. Not dramatically. But enough that you'll feel it. The emergencies will still come. But they'll stop feeling like the end of the world. And that shift, small as it sounds, is everything. The question is whether $10,000 should be the price of financial peace. Whether we've built a world where stability is only available to people who can survive years of instability first. I don't have an answer to that. But I know it's the question we should be asking.